What's interesting is that while we're not seeing much of a flows into the secondary market, a lot of demand coming for primary issuances, and yesterday nearly 40,000 crores of demand coming for paper, including the LIC OFS.
Yeah, that's right. Good morning, and thank you for having me on your show. I think that the minute the market has started to revive, a lot of people, investors, a lot of companies and investors waiting in the sidelines to sell have got into the act. And I think these flows are strong at the mutual fund. So all those offerings are being absorbed. Some of the companies which are being listed also very good quality companies like Manipal. So there's good quality paper, LIC also for that matter. And therefore the appetite is matching the demand which has come through. And this is a typical trend we have seen that when secondary markets are subdued, automatically primary markets dry up, block deals dry up, offer for sales dry up. But the minute we see interest coming back into the secondary market, then automatically all these primary market deals also start to take place, and the IPO market also perks up. It's nothing new, and this trend only will grow because the minute you do good deals, good IPOs, it attracts even larger IPOs. And end of the day, the end game over here is that you will get companies which are not completely ready for listing, but yet they'll be opportunistic and they will try and list, and then the valuation at which they list will always be on the higher side. So we have seen this thing play out many times in the past. So investors need to be careful that when they're going in the primary market, that valuations at least are there in their favor, and that there's margin of safety.
Even is it also the case that the new companies which are listing are having growth rates much better than some of the secondary market companies at this point in time, growing at 20% top line or bottom line and good decent EBITDA margins?
No, I don't think it's anything like that. There are all types of companies, interesting companies. Growth rates differ. Sometimes they are growing slower than existing peer groups. Sometimes they are growing faster. I wouldn't put a specific trend to it. But I'll tell you one thing. I find that the companies going public, generally they are priced at equal to or higher than the existing listed companies, which I find very surprising. For example, a recent company which is going public is RD, and that is going at that is basically a lead recycler, and it is going at just about the same valuation as some of the existing listed players. Or for example, there is Dhoot Transmission, which is into a wiring harness, that is coming at a P multiple of 42 times, when existing company Motherson Sumi Wiring is also trading at 42 times, and much bigger company. So these things are there. I think merchant bankers tend to get opportunistic, and they are driven by grey market premium as well. But I've noticed that when valuations are high, then the peer group companies, then eventually in 2, 3 quarters, maybe a year's time, that kind of a pricing premium does go away. And those stocks do tend to underperform despite good numbers also.
Deepan, I wonder what you make of LIC. I'll take a cue from your first answer. What do you make of LIC? 0.6 times price to EV, not looking particularly expensive, but growth isn't as strong as some of the other peers, I would suppose.
I had been an LIC investor right from listing, and I thought that the valuation was very attractive. At some point of time, it will start to trade at least at book, at the adjusted book value, and especially when private insurance companies are trading at anywhere from 2 to 4 times. So I thought there was a good arbitrage opportunity by LIC. Eventually, the P multiple or the valuation ratios will start to move up, but none of that happened. So then I sold off the shares of LIC eventually, and now I completely avoid it. I don't know, although things are looking good, growth rates do come in from time to time, and valuations still remain quite attractive. So I don't know what is wrong. And anyway, insurance is a very difficult sector to understand and track. So while we have so much choice elsewhere, we just decided to exit out of all insurance companies, LIC included. And I think that it's been a good decision, because end of the day, LIC is not kind of put the markets on fire, and there are so many other investment themes that one can chase rather than the insurance companies. Even within the financial services space, even within the financialization of savings investment theme, there have been so many winners like Angel, Grow, MCX, BSE Limited, the wealth managers 361, Nuvama, Anand Rathi Wealth, mutual fund distribution company like Prudent. All of these companies have generated fabulous returns over the last 2, 3 years or so, as compared to the asset management companies and the insurance companies. So that leads me to believe that within the financial services space, wherever there's scale and limited and less competition, that's where one should be invested in rather than highly competitive and highly regulated industries like AMCs and insurance companies.
That's a wonderfully candid take, Deepan. So thank you for that. Appreciate. Kunal, though, let me take your view. Do you believe that this kind of stock not turning around, in fact, trading at half the IPO valuation in relative price to EV metrics, is because of the supply that's coming, or expected to come? How do the charts read?
Specifically for
LIC.
Well, I think it's got to do with the kind of major part of it. It's more technical in nature because of the kind of supply the stock has seen. But I largely believe I think the stock on the longer term basis from the time of listing for the stock price, I think has just about seen one way trend for itself, which is on the downside. We've seen the stock I think at one point trading at the 350, 370 mark, if going through a process of a bounce. And then after yesterday's sell-off, the stock is back to that sub 400 levels. So it's really difficult to call in any kind of a major trend over here for LIC.
Okay, tough to call in a trend. Should you buy, sell, hold, Kunal?
Neither. I would say that because the stock is actually not showing any kind of a major signs. Just last week, it was trading above that long-term moving average and tried to come back above the long-term moving average after weeks and months of price correction. But immediately, the stock has seen a major downtick post this news flow. So this brings the stock back again to almost 8-10% lower than the long-term moving averages, which means that whether the trend would continue for the stock where it was over the last many months, or whether there's any kind of a revival, it's very difficult to decipher.
Okay, all right. We'll slip in a very short break, come back, take a bit of a breather. Plenty to talk about, frankly. There are a bunch of stocks which have come out with, or companies which have come out with earnings. We'll talk about some of them on the other side. Stay with us.
Back with the market, the GIFT Nifty nicely up in the green. So we're holding on around that 24,700 mark for the GIFT Nifty as we speak right now. But just so many earnings, and then you've got policy as well. So lots to digest. Dipan, hi, morning. Wanted to understand your take on Nykaa now, given the revenue and margins are both at a 12-quarter high, and it's actually the fashion segment and not BPC, which is, surprised on the upside. But would you say the positives for now at least are baked into the stock price in Nykaa? Or do you sense further upside in the stock in the next 12 months to come?
See, I think that we are constructive on Nykaa, and the fashion business had been a drag. It had underperformed. It had, produced results which were below expectation. But now that it has broken even, it's very positive. And then, typically these companies, they have very high operating leverages. And once they cross a particular level of sales, thereafter, whatever increases come through, a lot of it flows to the bottom line. So I would be very positive on Nykaa per se. It's amongst the few pure play consumption companies, and the BPC business is a classic FMCG business. At a time when so many where they are just about able to get volume growth in low single digit, you have hardly 2 or 3 companies which is in the BPC, that is the beauty and personal care segment. The other one, of course, being Mamaearth, which are doing exceptionally well, Honasa that is. So I'm very positive on Nykaa and would love to track how the fashion business is shaping up. End of the day, I think it's a company which is in the right space because more and more consumption spending is towards BPC, and the fashion industry is also going largely online in terms of sales. And then the company's strategy to set up their own stores, that's also playing out pretty well. So if you have a really long-term view, 3-year, 5-year, 10-year type of view, then I'm sure that Nykaa can deliver very good returns over a long period of time. Having said that, it's a company in which we are invested in, so our views could be biased.
Okay, that's the take coming in on Nykaa. There's Marico as well, good volumes. There's been a margin surprise for them. So, both volume-led growth as well as this margin beat turns out to be an ideal combo. Look out for what Marico does. Having said that, Dipan, there's been a very stark divergence within FMCG. Some players have got it so right, case in point being Marico, and some so not. Is FMCG really a space where you would recommend being invested in right now, as the monsoon impact is still to play out?
No, no, it's a completely avoid industry for us. And I know from time to time a Marico does give a good set of numbers. Sometimes it is Colgate, something or the other. There's Nestle, of course, which came with very good set of numbers. But to buy at 75 times PE multiple, I don't know how much return you will get, even if it continues to perform well. So I would say that for us, the traditional FMCG companies are a complete avoid. And as I said, that you have to go for new generation consumption themes or for new generation FMCG companies like the likes of Nykaa, there's Honasa, there's to an extent Zydus Wellness. I thought Varun Beverages also is going in the right direction in terms of not just carbonated drinks, but so many other kind of products they may launch over the next few years or so. And then there's, of course, they have the geographical expansion outside of India. So the number of the choice is narrowing within the FMCG space. And I do feel that investors who have had such fabulous returns over the last 30, 40 years, in the likes of HUL or Godrej Consumer or Colgate or Marico, Dabur, I think they need to really seriously review their investment, because unless a company can grow its volume by a strong double digit, it's no point remaining invested.
Right. Okay, that's the take coming in on some of the earnings. And of course, Bharti, the ARPUs have surprised on the upside, clearly sort of validating this tariff hike thesis and showing that pricing power is clearly sticking by, not just subscriber growth for Bharti. Bharti, of course, has been, strong but sedate, just circling around in this very narrow band. In fact, Kunal, I want to quickly get you to do a chart check on both Bharti as well as Nykaa and Marico, which perhaps may sharply react to their numbers today.
So I think Bharti could be an interesting case. The stock could probably try and come out of a major band of consolidation. It's been stuck into this 1900, 2000 range for the last 4 months. The bottom formation has happened for the stock price. Volumes have started to improve, but the prices have not been able to surpass this major hurdle point. So we may probably expect the stock to break past about this 2000 barrier and end the phase of consolidation. Nykaa, on the other hand, I think has been a stupendous rise. The last, I think, 2 or 3 months, we've seen a staggering move for Nykaa from a point where the stock was almost at 250, 260, being very volatile, to being a stock which is very stable at the 300, 325 mark where it's trading right now. So Nykaa, I think, could now be considered as a stock which is now charted off a long-term uptrend and looks attractive from a long-term perspective even at the current levels. Marico could be termed as a classic outperformer so far in the entire FMCG pack. Compare this with the likes of Dabur, HUL, etc. I think the stock has done exceptionally well on the longer-term basis, has been a lot more consistent chart. So I think looks attractive. Would look out for a breakout above 880 to 900 for Marico in the near term.
Dipan, what's the take on the capital marketplace? And I was just looking at BSE's earnings, very strong Q1, in fact, a record one at that. Strong momentum, the core trading business is continuing to outperform for them. Cash market expansion remains a strategic priority. And the IPO pipeline as well, very robust, and that's auguring well for BSE. This in the light of the impending NSE IPO, where are you scouting for opportunities, if at all, afresh within capital markets?
No, I think that within the capital market space, a lot of companies have done exceptionally well. BSE, for that matter, MCX also has doubled over the past year or so. It's a company in which we are invested in through our PMS scheme. And at the same time, I think some of the brokerages also have done pretty well. Grow in particular has stunned the market from time and again with exceptionally good numbers, even at a time when the market trends were not that great. So my sense is that within the space, lesser the competition, the better the returns are. So like BSE, NSE, MCX, the larger brokerages, which have got a tech background, a tech platform, I think those are the ones which can be preferred. And then, of course, there are the wealth managers, a bit disappointed with the numbers, but look, they are steady performers. And at some point of time, the compounding effect should give higher returns. So that's where we are. We are avoiding the AMCs. We are avoiding the insurance companies. Too much of competition, too much of regulation. And we prefer companies where I think that there's more flexibility in terms of operation, or they have a very solid moat around the business, like an exchange business person.
Right. Deepak, so good having you on the show. We'll let you go on that note. Thanks for taking out time as always.